Welcome. In this explainer, we're going to master what is truly the most fundamental tool in all of AS level accounting, the ledger account. So here's our game plan. We'll begin by defining what a ledger account is, then get into the mechanics of debits, credits, and how to balance an account. After that, we'll walk through a practical cash account example to see it in action. We'll then explore how this single tool is used across the entire syllabus, and we'll wrap up by explaining why this is the most critical skill you need to develop. Okay, let's start at the very beginning. What exactly is a ledger, and what is this T account that you're going to be seeing everywhere? Think of the ledger as the main central record book for a business. All transactions are first jotted down in what we call books of original entry, but the ledger is where everything gets properly sorted. Every single transaction, from a sale to a purchase, is organized into its own specific account. Visually, we represent each of these accounts with a simple T shape, and that's why we call it a T account. This T shape is the absolute foundation of the double entry system. You just have to remember two things. The left side is always the debit side, abbreviated as DR, and the right side is always the credit side, abbreviated as CR. All right, now let's get into the rules that govern these accounts. We'll look at when to debit, when to credit, and how we balance the account at the end of a period. The rules here are perfectly consistent. It's actually quite simple. To increase assets and expenses, you make a debit entry. To increase liabilities, capital, or revenue, you make a credit entry. The reverse is also true. A credit decreases an asset or expense, while a debit decreases a liability, capital, or revenue. Now, balancing an account at the end of a period is a very systematic four-step process. First, you add up the debit side and the credit side separately. Second, you figure out the difference between those two totals. Third, you enter that difference, which we call balance C/D or carry down, on the side with the smaller total. This makes both sides equal. And finally, you bring that balance down, balance B/D, to the opposite side to start the next period. Theory is one thing, but let's see how this actually works. We're going to apply these rules to a cash account for the month of January. So we start the month on January 1st. The cash account, which is an asset account, has an opening balance brought down of $10,000. Because it is an asset, this opening balance sits on the debit side. During January, the business receives more cash. There's $1,600 from sales and $1,250 from a bank withdrawal. Since cash is an asset and it's increasing, we record these receipts, which total $2,850 on the debit side. Of course, cash also went out. The business made payments for things like purchases, rent, drawings, salary, and some office furniture. These payments decrease our cash, and they total $9,300. Since this is a decrease to an asset account, we record all of these on the credit side. Okay, let's balance it. The debit side totals $12,850. The credit side payments are $9,300. The difference is $3,550. So we enter that closing balance C/D on the credit side to make the totals match. Then, that same amount is brought down as the opening balance B/D on the debit side for February. It's really important to understand that the T account isn't just for basic transactions. You are going to see it and use it in various forms across the entire AS level syllabus. From tracking your non-current assets and their depreciation, to managing bad debts, to summarizing totals in control accounts. Even in partnerships and limited companies, you'll be using T accounts for capital, current accounts, and retained earnings. The structure is always the same. You'll also encounter more specialized accounts, like disposal accounts when you sell an asset, or suspense accounts for correcting errors. Even these rely on the very same T account principles of debits, credits, and balancing. So let's bring it all together and talk about why getting comfortable with ledger accounts is without a doubt the single most important technical skill for your success in AS level accounting. Why are they so essential? Well, they provide a complete history for any item. They are the engine that makes the double entry system work. They allow us to systematically calculate closing balances, which we then use to prepare the trial balance. And they're a crucial tool for finding and correcting errors. But with everything you have to learn, why is this one skill so vital? Why should you master this above all the other technical things you need to do? The answer is its universal presence. A solid understanding of T accounts is the foundation that every other accounting concept is built on. They show up in every topic, in every calculation, and in every single financial statement question you'll face. Mastering this is the key to unlocking success throughout your AS level studies.